Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. After a massive 12% move off the October low, the SP 500 rejected off a very significant resistance level. This price channel resistance right here, along with the 3,900 point level that acted as both support and resistance throughout 2022. So to put a little bit of context behind what's going on today, we had a very oversold technical structure here back in September, October of 2022. Bearish sentiment going through the roof, and so you had that technical bounce, the nice bullish setup as price was coming down to make a lower low, momentum turning back up, a beautiful rally off that low, and then the Fed came in right here and talked the market down, right? Jerome Powell made his speech, the market rejected off that resistance level after a 12% run, so big 2.5% move down in a single day. And many investors were very concerned that this was another one of those moments where the Fed was going to trigger a much larger move down in the market, just like they did right here in August of 2022. At their Jackson Hole meeting, the Federal Reserve came out with a very hawkish tone, saying they would do whatever needs to be done to get inflation down, triggering what then turned out to be a 17% drop in the market, a massive move down. So many people are concerned that this was just another one of those and that we're going to see a 15% drop following that meeting. Now, so far, the market is still within this bearish structure right here, but it is showing signs that potentially there's room for the market to move higher. So why is that happening? What was actually said in that meeting? We're going to talk about that in this video. If you've been following us on Twitter, this is one of our recent posts highlighting the put call premium. This is the 10-day moving average of the put call premium going through the roof here, meaning investors are really paying a record amount to hedge against downside on the market with puts relative to call options. Now, it's not a perfect indicator, but we've often seen these types of readings near very important bottoms in the market. So this is just to show you the extreme bearish sentiment we have right now, the record number of people that are actually thinking the market needs to go much lower from here, or at least concerned that this is just another one of those moments where the Fed is surprising the market and that it's ready to roll over. So that's what we're going to cover in this article. Is that actually true? Why is this momentum potentially turning back up again? And what to watch out for in the next few trading sessions. If you are new here, by the way, don't forget to click on that subscribe button, because we make these videos discussing what's happening on the markets, understanding where the opportunities are multiple times a week. And of course, if you enjoy this video, don't forget to smash that like button as hard as you possibly can. And now, without further ado, let's get right into it. So in this article that we posted on gameoftrades.net, we made an in-depth overview of what happened at that FOMC meeting, what the market reaction was, and how we should think about it going forward. So interestingly, there's a couple notes that we made following the meeting that were very interesting and that did shift in terms of what they talked about at that FOMC meeting. The key comment that came from Jerome Powell, in my opinion, is that he acknowledged that lags in policy tightening need to be considered, right? And that makes sense. Well, we've seen a historical tightening cycle here. The federal funds rate, short-term rates have moved higher very quickly and intensely over the past year. But the first rate hike was really in March of 2022. So the tightening cycle didn't really happen until March. So something that we've been actively talking about is that tightening, if you've been following us, you'll know that we've done a lot of research on this. The tightening takes a long time to actually feed into the economy, feed in to stock market earnings, economic growth. There is a big lag in monetary policy. And so the tightening that we saw in March is barely being felt today. So when they go on a historically aggressive hiking cycle, right, this is a scary chart. If you think about how much tightening is happening right now, that's only going to be felt later down the road. And so that's exactly one of the things that we were waiting for Powell to acknowledge, is that there is this lag in monetary policy and that they've already done a lot of tightening that opens the door for the Fed to perhaps cool down the hiking cycle, even though inflation is still running a little bit hot, while they wait for the effects of that tightening to come into the economy in a big way. And so this is one of the key reasons why we didn't believe that the market should be a lot lower following that Fed meeting, because essentially he came out with some pretty dovish comments, right? That comment alone is very different to anything that we've seen throughout 2022. That's my opinion. You can share what you think about this in the comments section down below. But what's interesting is that it's also reflected in market expectations, right? You look at the Fed terminal rate, so the market expectations of where the Fed funds curve is going to be throughout the next couple of years. And you can see it moved after the meeting, right? It moved a little bit higher. Pre-meeting is in black, post-meeting is in red, but it's not a big deal. The terminal rate barely moved higher. And when you look at probabilities of rate hikes for December, pre-meeting, the market was pricing in a 75 basis point increase for the month of December. After the meeting, it's now much more likely to be a 50 basis point hike. So market expectations are telling us here that for the first time after a meeting, the Fed is trying to cool down the hiking cycle. It's the very first time we're seeing that. So from a perspective of what the Fed has said, to me, it's bullish, right? Even though the market reaction was poor, I think that's just because the market was at resistance. It was a little bit overextended after a 12% run. Nothing goes up in a straight line, but the meeting by itself wasn't terrible news. And that's why we remain convinced that a cool CPI reading, a lower than expected inflation print for the month of October, which is entirely possible. I think we're getting into that period where it's increasingly likely that we'll see inflation start to surprise to the downside. If that happens, well, you're going to see, first of all, the bond market react. You're going to see a big rally on the bond market, and you're going to see stocks break out here. You're going to see them revisit that 4,100 point level very quickly. That can trigger an intense rally. Now, of course, we'll be covering that on gameoftrades.net. We'll be posting a review of the CPI reading and the market's reaction to the CPI reading on Friday, assessing whether we need to make any changes to our targets, to the ratings that we have on our watch list, or to the model portfolio. Of course, we'll be communicating that every step of the way to you guys, because that's really what our service is about. We try and guide you through the noise, through the market price action, through the macro developments, and make you better informed to make smarter decisions. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and of course that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.